Catherine, we haven't had you on the podcast for 3 weeks. Have you been, what? Nothing's happened.
Every week, I hope, and the call doesn't come. So I'm very excited today.
Our prayers have been answered, right? We've got some news, big bang news, in fact.
Big bang news. Although I guess we're slightly wondering, is it a small whimper that they're trying to package as a big bang now? We're in that territory.
That is the question, right? When is a big bang a small whimper? I think that's what we need to answer today.
This is such a philosophical question. Stay tuned for the answer.
I'm David Merritt.
And I'm Francine Lacqua.
And this is In the City, Bloomberg's podcast connecting you to the stories and the voices at the heart of the City of London.
This week, Big Bang 2.0. It's back, Dave, of course, being the long-promised relaxation of post-Brexit financial services rules.
That's right. Everyone in the city has been waiting for this, and we've had a big step forward this week.
We voted for Brexit, and now there's an opportunity to sweep aside unnecessary rules and regulations that were holding back economic growth. So what will they mean? Dave, my conversation also with the newest Lord Mayor of the City of London, Nicholas Lyons. He shares his vision for elevating the city during his year as Lord Mayor.
And then this week's big news, we have the relaxing of what is called the ring fencing of banks. That was a rule brought in after the financial crisis of 2008. Seems that is about to be scrapped. So we're going to talk to Bloomberg's finance editor, Katherine Griffiths, who will walk us through what ring fencing is, why there's been a change of heart, and how the UK plans to turn this into its next big bang.
So, Katherine, welcome to the podcast. We may no longer have ring fencing in the UK. Is that a real game changer for banks?
Yes, it would be a big game changer if they really did take down the ring fence. I think quite possibly they'll do something smaller than that. They may mess around with the level that the ring fence kicks in at, which is £25 billion of deposits. They may mess around with the rules so that it's easier for banks to sort of serve customers that fall on either side of the ring fence. They may exempt kind of smaller banks that don't do anything risky. We're not quite sure at this point.
So just to explain to our listeners who might not be that clear what ring fencing is, Katherine, this was the idea. The idea was to separate out retail banking, so general consumers and their bank accounts, from the kind of the risky stuff, right? The investment banking and all the stuff that blew up in 2008. Can you explain what the thinking was there?
Yeah, that's exactly it. So ordinary people had to spend £46 billion bailing out Royal Bank of Scotland and many other painful things too. After that, the idea was that we should never have to do that again. So one of the measures that was put in place was this ring fencing idea, so that banks, big banks, should slice themselves into two parts. The sort of high street lending to individuals and small businesses, medium-sized businesses, that stuff goes inside the ring fence. And then the riskier, more volatile investment banking business, which sits in another entity outside the ring fence. And the idea is that if that bank gets into trouble, the investment banking business can be left, can fail, and that's fine. The market can absorb that, but that the safe retail deposit, small business lending part needs to be protected. It needs to be a much safer institution with its own capital so that taxpayers don't in the future have to bail out those entities ever again.
But so, Katherine, just to be clear, these measures, as you say, basically designed as ways to avoid another future taxpayer bailout, were not EU mandated. They were British rules.
Yes, they were British rules. And the idea was that banking makes up such a huge part of the UK economy. It was a really central part of the thinking of officials at the time that we needed to have these really, really safe, robust rules.
But so no other banks in Europe had to do the same?
So European and US banks have versions of ring fencing, but one of the arguments put forward in this country is that our rules are particularly draconian.
Right, but this being billed as a Brexit dividend, that's not quite right then, is it? This is something we unilaterally introduced in the UK and therefore presumably, even if we were still in the EU could unilaterally remove.
Yeah, that's right. This doesn't have to be a Brexit dividend. And there's been thinking on tinkering around with the ring fence for quite a while. I mean, weirdly, actually, ring fencing only came in 2019 because it's so kind of complicated and cumbersome, and banks collectively have spent about £3 billion making all the changes they needed to make. So officially, it's only been with us since 2019, but there's a view that, markets change, economies change, and so there needed to be a sort of rethink about whether we still needed ring fencing.
So under the Sunak government, I guess ring fencing has been one of the many, many pieces of legislation under review and trying to help to bolster the financial service sector.
Yes, it's been reviewed by Sunak and someone called Keith Skeoch, who's a senior business figure, was commissioned to do a report. He did that report and he recommended a range of things. It was quite a sort of conservative report, but it did say that these smaller banks that didn't do anything risky perhaps shouldn't be subject to ring fencing rules.
I mean, it's a bit of a sort of regulatory car crash, isn't this? I mean, 2008 was the financial crisis. The world nearly came to its knees in terms of the banking system. Then it takes more than a decade to implement this rule that's supposed to protect people's savings and personal bank accounts. And just 3 years later, they've decided it's not fit for purpose.
Yes, I mean, I strongly suspect they won't actually do anything particularly radical on ring fencing. I think they may tinker around with it. And the thing is, if they exempt the likes of TSB, Virgin Money, these sort of medium-sized banks in this country, that's great for them, but it really won't kind of release billions of pounds of capital into the economy because they don't really do anything that's not ring fence business. So if they suddenly don't have a ring fence, there isn't this sort of magical benefit that will be created. I mean, it's probably a sensible measure, but I think perhaps the notion that it will kind of unleash lots and lots of capital into the economy might not be true.
Because we've got the City Minister, I've got a quote here from him, Andrew Griffiths, who said this week, we can make the UK a better place to be a bank to release some of that trapped capital over time around the ring fence. But sounds like what you're saying, Katherine, he's not being entirely straightforward there.
Well, I mean, that's a shocking thought for a minister not to be straightforward. I mean, I think it will be really interesting to see what they're actually planning. One of the kind of sort of juicy aspects to this is whether they raise the level from 25 billion, that's the level of deposits you have before you have to go into the ring fence, to say 50 or 100. Because if they go down that path, some of the chief beneficiaries could well be the big American banks. So Goldman Sachs' Marcus has about £23 billion worth of deposits at the moment in the UK. And Chase, the digital bank from JP Morgan, has sort of just over 10 at the moment. So if they tinker around with the level, then it might be those banks that have big benefits.
So Big Bang 2.0, was this like a Liz Truss? Was this something under Kwarteng? And this goes back to, it harkens back to the wave of deregulation in 1986, which at the time actually really made London a financial center. But things are different now. We're not innovating like we were in 1986.
No, and actually, one of the things I think is quite interesting about back to the 80s, I was talking to a very senior person from the city, someone called Sir Nigel Boardman, who is now chairman of Arbuthnot Bank and was a very senior lawyer at Slaughter and May for a long time. And he was reminding me recently that he used to sit on kind of panels back in the 80s asking which kind of European financial centre will be the preeminent one, just as Big Bang was happening. And he was saying that it wasn't at all clear at that point that London would in fact come out on top. And of course, that is what happened. So that was an inflection point. And, the optimists now think it's an inflection point too now.
I mean, although a lot of the stories, and we've talked about this in the city in the last few weeks, have pointed the other way, haven't they? We've seen Paris overtake London in terms of the overall market capitalisation of the stock market. We've had stories this week about Goldman Sachs moving jobs to Milan. The picture of London's dominance in Europe is pretty murky at the moment, isn't it? And the long-term trend seems to be a drift of capital trading to other centres in the European Union. I mean, this measure, which sounds like it's less impressive than perhaps on paper, isn't going to reverse that, is it?
No, that's certainly not going to reverse it. I mean, what we're waiting for, very excitingly for our Christmas present, is a wider a wider range of ideas from the City Minister, Andrew Griffith. They're meant to be coming before Christmas. So, perhaps along with this...
With his Santa hat on.
With his Santa hat on, going around the city, who's going to get a lump of coal.
Satsuma.
The Satsuma, yes, exactly. There will be others. So we may get some others and I suppose the point is perhaps that, cumulatively, they may well have an effect. I mean, people will say London has huge liquid markets and lots of expertise, the language, the time zone, all the rest of it. I mean, these are very substantial things. So if Griffith does in fact come up with some really sort of meaty ideas, then perhaps it will make a difference.
Katherine, thank you so much. Always on the money. Katherine Griffin there.
Thank you. I mean, Fran, I just think it's amazing that this big bang, so-called, that the government is trumpeting, when you stop looking under the hood, it's really nothing of the sort, right? And I just think, what is the city going to really be able to do substantially that is going to move the needle here?
Yeah, maybe it's nothing of the sort, but they're trying. And this maybe was something different that we didn't have under the Boris government. And Dave, I spoke to Nicholas Lyons. Now, he comes from a financial services background, which is a good thing for a Lord Mayor at the moment.
That's right. He's somebody who's worked in the city for 40 years. He's been an investment banker for more than 20 years. And for the last 18, he's sat on the boards of insurance companies and asset managers. And he's now taking a sabbatical from being chairman of Phoenix Group to take on this role of Lord Mayor.
And his main point is really it's time to capture maybe some of the positives of Brexit. So we began by discussing how he's seen the city evolve over the past 40 years.
It has changed dramatically. I mean, when I started, we still had stock jobbers who used to walk around the City of London in top hats. So fortunately, we've moved on from that.
No longer, except there's a little side street around here, actually, where they do wear top hats from once in a while.
Well, that's true. But I think, technology has made a huge difference. Globalization has made a huge difference. And we have always managed to attract the brightest and the best from around the world. And that's, I think, hugely to our credit and hugely to our benefit. And I think that's probably the biggest change of all. Back in 1982, it was a very sort of British city. And now it's a very, very multinational global city.
And this is thanks to regulation. I mean, there was an attraction of capital to the City of London, which was actually quite incredible in the last, 14, 15 years, which I imagine has to do with the time zone.
Time zone has been always a real help. But when we started looking at 24-hour trading for international banks and asset managers, that really played to our strength, sitting between New York on the one side and Asia on the other. So that, I think, has been a big benefit. But clearly, changes in regulation, Big Bang, was a transformative thing, and now we're talking about Big Bang 2.0.
But in the meantime, has it declined in the last 4 to 5 years because regulation has not really been maybe as nimble as other places like Amsterdam, or not been as aggressive enough as New York?
I think it's absolutely fair to say that other financial centres have tried to take advantage of the uncertainty that was created by Brexit to try and build their own capabilities. But actually, we still have the same number of people employed in financial services here. We've still managed to increase the assets under management here in the UK, about 10 trillion pounds of assets, and international assets up from 4.4 to 4.6 trillion. There is never room for complacency. And actually, the way I look at it is this is a wonderful wake-up call for London as a global financial centre as we look at the technological changes that financial centres like Singapore are introducing. That will help trigger a response from London that will be strong and cogent.
But overall, has it lost something? Since Brexit?
I don't think so. I really don't. I think there were always going to be people in frontline jobs that, because of Brexit, had to relocate to other parts of Europe. But we've seen, small impacts in Dublin, in Luxembourg, in Paris, in Amsterdam, in Frankfurt, but nothing compares to London. And London is always going to be the most powerful, the most important, the most relevant global financial center in our time zone.
But I feel like every 2 weeks there's a story saying, well, Amsterdam overtook us on, on pipelines or IPOs in the pipeline, or there was a story in terms of the how big the stock exchange is. France overtook us 2 weeks ago.
Yeah, you can. But you're always going to find little anecdotes to support a particular theory. It sort of depends which end of the lens you're looking through. But it's not so much that London has to be the biggest at everything. The fact is, what we are is an extraordinary ecosystem that's got a significant chunk of everything. And it's when you put the whole thing together, it's not just financial services, it's also, or traditional financial services, it's also fintech, which is where we're real leaders, but it's also the whole legal infrastructure. So, the primacy of the rule of law and our independent judiciary, the fact that contracts are written under English law all over the world, people want disputes to be resolved here in the UK because of the quality of our judicial system. So, and we've got terrific risk management, compliance, technology, management consultants, auditors, actuaries, you name it. It's when you look at it in the round, it's. I'll stop short of saying it's impossible for anyone to challenge that, but it's going to take many, many, many decades of concerted effort. And frankly, I don't think that's going to happen.
But Lord Mayor, the City of London with Boris Johnson as head of government is maybe different to the City of London with Prime Minister Rishi Sunak, just because of the amount of attention and love it got from Boris Johnson. Is that fair?
I think what I would say is that we now have in number 10 and number 11 two people who really understand not just business, but financial services. And that's, I think, very, very important, because we can't have a thriving national economy without an immensely strong city of London. And in purely factual terms, we know from the reaction of the bond markets to the Liz Truss-Kwesi Kwarteng period, of Trussonomics, as it's called, that there is a limit to the amount that you can just borrow to pay your bills. So we need growth and we need investment, and that has to come from the private sector, primarily from the private sector, because the government doesn't have a huge resource at its disposal. There are two massive pots of capital in this country. One is in the real estate market and the other is in the pension market. And we need to mobilize pension capital. So
you have an agenda of things that you want to if not push through, certainly reform for the City of London.
Yeah. So there are three big areas that I really wanted to focus on in the course of my mayoral year. And it is just, I'm afraid, 1 year. One is an initiative around the global investment futures. So this is a scheme that corporation works on with the Investment Association and the Department of International Trade to attract overseas capital from large asset owners to come into the UK and be managed in the UK. And we have a plan by 2030 to increase from 10 trillion, the amount of assets that we have being managed here, to 20 trillion pounds. The second area is around financial inclusion. And within that, a sort of subset of financial literacy. Financial inclusion is a real challenge at this time with the cost of living crisis that we've got. We've got 17 million people in this country with savings of less than £100. So, and there's only 1.5 million of those who are unemployed. So over 15 million people in this country are working, they're in work, they're earning a wage, but they can't think beyond the budget for the next week. So I want to convene a meeting with a lot of the large financial service organizations, with the charities that are involved in financial inclusion, and see if we can't get a really good plan of what's best practice around how we can help people through
And it's easier to go that way instead of the government doing it because it's more efficient, or it gets there quicker?
I just think that it's the people who are have the customer relationships. It's where the rubber meets the road. So there's a default, I think, to say the government should do everything. The truth of it is the government can't do everything. And I'm here to promote a resilient, resourceful and responsible city. And therefore, this is a really important area where the city can be responsible.
How difficult will it be to attract international capital to the UK, given the turbulence in markets that we saw in October?
When I talk to sort of sovereign wealth funds around the world and ask them to allocate more money here, and they raise this issue about sort of political turmoil, I remind them the city's been around for twice as long as we've had parliamentary democracy in this country. You know, we have survived everything that's come our way. We shouldn't lose sight of the fact that long-term gilt yields are now down to below the levels that they were at before Liz Truss became PM. So the panic that there was in international markets, you know, bond investors are very sophisticated. You know, they do the maths. They look at government plans and government strategies. And the Prime Minister and the Chancellor of the Exchequer, to be fair, have put together a really coherent plan to get us to, balance the books. You know, that has restored confidence. I don't think one should necessarily look at what happens to the pound against the dollar and come to any great conclusions, because that's more to do with what's happening in the US.
I wonder how much you think Brexit contributed to a tight labour market and therefore putting pressure on a lot of wages.
I don't think that there was a huge amount of support in the city for Brexit. I think the city looks always at its competitive position, and you don't want to damage your competitive position if you can avoid it. But the fact is, you know, that happened in 2016. You know, we've moved on. What we do need to do now is work together to make sure that we can take advantage of regulatory freedoms, so that I think the problem that we have at the moment is, you know, we had the Brexit was always going to have, you know, some negatives, but we always hoped that there would be some positives as well. We've taken the negatives, but we haven't captured the positives yet. So the announcements on Solvency II at the autumn statement were the first signs of that, and you know, very welcome they were too.
How did you? So I talk often about Solvency II, but we don't want to bore everyone who's listening, although it's extremely important. What was positive in that? Did it make you think that the Chancellor understood some of the pitfalls of what the financial services are dealing with?
Oh yeah, absolutely. And again, you know, to have a Prime Minister who worked for a American investment bank and a hedge fund means that you can have detailed conversations about technical things which are completely understood. And I would actually also take this opportunity to pay tribute to John Glenn when he was City Minister and Economic Secretary to the Treasury, who worked tirelessly in getting to know about these issues and worked very, very well with the Treasury, particularly Gwyneth Nurse, who's now Director General of Financial Institutions in the Treasury. They should take a huge amount of credit for where we are, and well done to Andrew Griffiths for grabbing the baton and running with it. And it's very good for the city to know that now John Glenn is back as Chief Secretary to the Treasury. So I feel that we've got good people who are very knowledgeable in important positions, so that we can have these conversations.
There was talk about ministers being able to overrule some of the regulation-specific cases. And I still can't figure out whether that's good or bad, because it does, if you have a rule of law and regulation here in the UK is gold A standard, does it hurt that regulation? So does it actually take away business?
Yeah, I think you're talking about the call-in power
Yes.
that was being considered. The city was not supportive of that for the simple reason, and you sort of pointed to it with your question, which is that when you get political interference with due processes of the regulator, you're inevitably going to get inconsistencies in the way that that's used. And so you'll get more volatility, and that's not what businesses want. We want a strong regulatory regime, which we've got. We've got an absolutely excellent chief executive of the PRA in the form of Sam Woods. and an excellent chief executive of the FCA in the form of Nikhil Ratti. They have very difficult jobs to do, but they do it extremely well, and it's very important for us as a global financial center to have the reputation of strong regulation and strong regulators. I would much rather, as a business, as a city business, or as a city Lord Mayor, deal with the chief executive of the PRA than a politician.
What do you think will be most frustrating for you when you look at some of the regulation? And I know you're very positive about the future of the City of London, its place in the world, and how it can attract capital and talent. If you had a magic wand, is there something that you would change today?
Yeah, and this comes to the sort of the third piece of what I wanted to accomplish in the course of my mayoralty. The theme of my mayoralty is financing our future. And the components of that are Solvency II reform, so I can put a big tick in the box there. I can't take any credit myself. Happened in week one. Second is green and sustainable finance, where London has a huge role to play in that global debate. But the third really important area is the growth economy. And this is the area that that at the moment is of immense frustration to me, and where I would really want to see great change. We have got, and we have had for decades, great entrepreneurs building great early stage businesses. We've got 4 of the best 10 universities in the world, 7 of the best 20 universities in the world. We've got good venture capital that goes into those universities, but we don't have the depth of capital markets to provide the accelerator funding for this. So time and time again, sophisticated international investors have come in and provided that capital and indeed some expertise. And then these businesses get sold internationally, or they list on US exchanges. And about 50% of the capital that comes in to invest in these businesses comes from North America. So this is the area which we've really got to address.
How do you fix it?
Well, you fix it, and there have been a lot of reviews of this. So Jonathan Hill, Lord Hill, did his Hill review. Sir Ron Khalifa did his Khalifa review. Now Mark Austin from Freshfields has done a secondary listings review. These are all extremely important parts of the jigsaw. Now, under the leadership of Julia Hoggett, who's the chief executive of the London Stock Exchange, we have the Capital Markets Industry Task Force looking to identify the regulatory and the statutory changes that need to be made, and also the practice changes on the listing rules side, so that we get rid of those obstacles. And what we need to be able to do, and this I believe really, really strongly, is that we need to be able to mobilize the DC pensions, defined contribution pensions, and to get them to invest in this asset class. They don't have to invest much, it's sort of 5% of funds, but that would make a huge difference.
Lord Mayor, if you were to give the City of London a report card, what grade would you give it today? And what grade would you give it in hopefully at the end of your tenure in 12 months?
I would say that the City of London today is an 8.
Okay, out of 10?
Out of 10.
Not bad.
And I want to get it to a 9. Because we're never going to be perfect.
Almost perfect. Lord Mayor, thank you so much.
You're very welcome.
Thanks for listening to this week's In the City. We will be back next week.
But in the meantime, if you like our show, please head on over to Apple Podcasts or wherever you listen to podcasts and rate, review and subscribe.
This episode was hosted by me, David Merritt.
And me, Francine Lacqua.
And it was produced by Summer Sadi.
Editing and sound design by Blake Maples.
And special thanks to Katherine Griffiths and Lord Mayor Nicholas Lyons.